Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering our segment of 5 stocks with X dividends next week. So this will be the very first week of 2018. I cannot believe how far we have came. We're at 291 subscribers right now. We are almost at the 300 threshold, and that's great. We also have 82 likes and followers on Facebook, so I do post a lot of unique content on there, articles that I read, such as relating to tax and all sorts of different changes on there that I feel could benefit all the viewers and subscribers out there. So go ahead and like me on Facebook and like my Facebook page for those fun little articles. So I do have 5 stocks for you guys this week. I've already screened through about 40 different stocks, picked out 5 stocks. They have price to earnings ratios less than 25, and they have yields greater than 1.5. I didn't find any great stocks. There were some good stocks. I do have some stocks with yields over around 3 or higher, I think Cisco is right around there, and I did remove some of the ones that didn't have increasing free cash flow or increasing net income or increasing revenue. I think that these 5 were some of the better of the lists of however many stocks I kind of covered. So we will be going over the dividend dates, the price comparison to yield, the PE in comparison to the average industry, the payout ratio, and the dividend history, and a few other stats. So 5 stocks ordered by X Dividends January 1st through January 5th. The very first stock is Comcast. So Comcast, ticker symbol CMCSA. We've talked about this in my 4 stocks I'm looking to buy or invest in December. I believe AT&T and CenturyLink I've actually invested in December. I didn't quite make the punch for Comcast. You can see this huge hike up here. I know Ryan over at the Independent Investor, he invested in Comcast and got a nice 8 to 10% increase there. Comcast is still on its way up. So as you know, Comcast operates as a cable operator in the United States. It offers various consumer, entertainment, and communication products and services. The company itself operates in 2 segments, cable and programming. So the programming segment operates its consolidated national programming network. So the X dividend is next week on Tuesday, so you do need to own this stock on Monday or prior. You would then get paid out within the same month on the 24th of January. So it's a great 1, 4, 7, and 10 stock. They're a quarterly paying stock. Now, I decided to, instead of going over their 1 year, switch up the graph to 3 years. That way we can see their history for their PE ratio, we can see their history for their dividend increase, we can see the history of their price, yield, and price to book values, which are all very nice to look at visually. So here we can see that Comcast has had some very nice increases. Looks like it increased a couple times here back in 2015. It increases right around the same time frame. So we can expect another hike in dividend right around the March, February area. So the last time they had an increase, it was an increase of 14.55%. So this stock I would consider very similar to Apple, Nvidia, and Activision Blizzard. They have a low yield, but they have growth with them, and they have nice dividend growth per year. So let's see here, their PE ratio is 19.67. Their yield right now is at a low 1.49. You can see that at a point in January 2016 they actually had a yield of around 1.86%, somewhere in that frame. So you can see that this stock itself, it goes between a 1.35 high or a low for its yield and a high of around 1.84. So right now it is sitting below average for its yield, and it's sitting above average for its current price. And we can see that its PE ratio is trending sideways for the most part. It's about average. You can see the low is right around 7.5. Again, you can see that the high is around, we'll say 22, so 19.67. It's around a middle ground for that specific stock, and you can see that its price in comparison to its book value has been at a nice incline together. So Comcast, when charted, it does show that the current stock has a higher price to yield, which would indicate it may be overvalued at this time. The stock itself is under in the industry price to earnings average, below 60% payout ratio, and has had dividend growth for the last 6 years. Their price to book value is 3.44, and which is higher than 3.0, where value investors would consider a value. You can see for the most part, this stock really doesn't fall, too far or too below a 3.4 or 3.0. You can see it kind of trends along the line, and it was sitting right around a 3.0 back in 2016, and then it's began to trend up after 2016 January, and it's been on a nice steady incline. So we've already covered the PE of the stock. The industry average is 28. They have a dividend yield of around 1.49, 1.54. Annualized payout, they pay 63 cents per share. Their payout ratio is 30.7. Dividend growth is 6 years, and their annual dividend growth is around 14.55%. So very nice increase in their dividend. So good stock there overall. The next stock we're going to be covering is ticker symbol BMY. Now this is Bristol-Myers Squibb Co. It's a global biopharmaceutical company that operates and partakes in the discovery, development, licensing, manufacturing, marketing, distribution, and sale of biopharmaceutical products. The products themselves are sold globally to wholesalers, retail pharmacies, hospitals, government entities, and to the medical profession. So very international stock right here. Their ex-dividend date is next Thursday, so on 4 January. So you do need to buy the stock on Wednesday or prior, and you would get paid out on the very 1st of February. We can see that this stock has very nice increases as well. Looks like they just declared a dividend increase right around, say, September timeframe, so they will be paying out 40 cents per share in their next increase. So we can see that this shows around a 2.54% yield. This one down here shows around a 2.61, so this may be a little bit closer to where you're going to be purchasing your stock. So right now they pay out 40 cents per share. Their yield is over their current price for the last 3 years. We can see that their highest yield that they had was over a 3.0%. Their lowest they had was around a 2%. So right now they're sitting at about average or even for the last 3 years. They're currently priced at $61.39, and it does look like it's been swinging down since July of 2016. It's been going on some very low, right around $50 marks before bouncing back up. So this one, it could be, it could be a wild game right here. That could go up, it could go down. You'll have to do your research on this one. PE ratio is at 24.17. You can see that its price in comparison to its earning, well, at a point was around 75. So it did come down hard, and that's probably why it had such a hard pullback from $77 all the way down before it hit its support line right around $50. Came back up and fell down again. So if you could wait this stock out until it dropped down into the $50 range, you could definitely be on the safer end. Their price to book value is at 6.7. So BMY, when charted, it shows that the current stock has a higher yield to price, which would indicate it may be undervalued at this time. The stock is under in the industry price to earnings average, below 60% payout ratio, and has had dividend growth for the last 7 years. Its price to book value is 6.79, which is higher than 3.0, where value investors would consider a value. So the stock is at 23.9, the industry is 24.6, the yield is 2.61. They pay out $1.60 per share. Their payout ratio is 53.5. They've been paying out dividends for the last 7 years, and their last annual growth was only 2.56. So not an amazing stock here. They are kind of a risky stock, in my opinion. Next we have Cisco. Cisco Systems. I can't talk right now. My nose and everything is just bothering me. Ticker symbol is CSCO. Now, Cisco Systems is a technology and security company that designs, manufactures, and sells network equipment. The company focuses on 3 main segments, which includes enterprise and service provider, small business, and the home. They've been trying to pull back on their hardware recently and been trying to go more into security, so their security segment has been growing very nicely. I'm currently a holder of Cisco and will be continuing to hold it for the long term. I do believe that this company will have very nice growth in the future as they continue to switch from a hardware company to a security. They have a lot of good products such as Stealthwatch, ICE, a few of which I've used myself. So Cisco, when charted, it shows that the current stock has a higher price to yield, which would indicate it may be overvalued at this time. The stock is under in the price to earnings average. It is sitting below 60% payout ratio, and it's had dividend growth for the last 6 years. Its price to book value is 2.89, which is lower than 3, where value investors would consider it a value. Again, their ex-dividend is Thursday, so you do need to buy this stock on Wednesday, and then you would get paid out in the same month on the 24th of January. So this is another 14710 paying stock. Their dividend yield right now is sitting right around 2.94, 3.01, depending on where you bought it. I've held the stock back since around September, actually July, I believe. So I bought it here when its yield was around 3.45. So I've been holding the stock for a while. The dividend yield itself, we've already covered that. They pay out $1.16 per share. Their payout ratio is 52.5. They've had dividend growth for the last 6 years, and their annual dividend growth is 11.54. So if we take a look at their price to earnings ratio, there was a time when they're kind of trading at a pretty high PE ratio in comparison to where they were maybe in January 2017. They have been trending upwards as far as their price in comparison to their earnings. So this could be one that you may see a bit of a pullback, or it could be one that they just could be continuing to grow, and as their company continues to change, the company will continue to get more profitable, which will kind of balance out that earning. And let's see here. Yep. So on to the next one. Number 4 is ticker symbol GNTX. So Gentex Corp designs, develops, manufactures, and markets electro-optic products, including automatic dimmer, rear-view mirrors for the automotive industry, and fire protection products for its commercial building industry worldwide. They also do mirrors, like they do electric mirrors that adjust, and they're anti-fog. So semi-diverse. They do a lot of car products. Their ex-dividend date is on Thursday, which is the 4th of January. You would get paid out very quickly on the 17th of January. They pay out 10 cents per share, but they are a growing company here. You can see that they started off paying back in 2015 right around 8 cents maybe, right around around 7 cents. They increased it to around 8 cents, increased it to around 9 cents. They did a huge increase here in 2017 to 10 cents, which is an increase of 11.11. They're very priced. They're actually, next is the PE ratio, 16.76. So this one, it's been trending kind of down in the last couple years here. You can see that it used to be priced pretty high, around 18.33 or higher. It may be coming off a high streak there and trended down right around the 14 before the stock started to pick back up, trended up, and then kind of trended down along with the PE ratio, and is on its way back up. So I can see the stock continuing to go at a nice increase there. Okay, back. Our kiddo was coughing up a storm. So anyways, the yield has been moving on a downwards trend. We can see that this stock has not a support, it has a resistance barrier right around what looks like maybe $22. So this stock may not be a good one to buy into right now. This one may have a bit of a pullback. So hold on one second. Clear my throat. So anyways, if you do invest in the stock, be careful. Definitely do your research to see if it will continue and be able to break the barrier that is $22. Otherwise, you could see the stock fall back maybe down into the $17, $18 range before coming back up. Anyways, price to book value is right around 2.93, and that seems about average for the last couple of years. So GNTX stock, when charted, it shows that the current stock is a higher price to yield, which would indicate it may be overvalued at this time. The stock is over in the industry price to earnings average, under 60% payout ratio, and it's had dividend growth for the last 6 years. The price to book value is currently sitting at 2.93, which is lower than 3.0, where value investors would consider a value. The stock is currently sitting at a 16.6. Industry is 14.5. So dividend yield is 1.81 to around 1.91. They pay out 40 cents per share for the year. So if you multiply 10 by 4, that's 40. Payout ratio is 31.5. Dividend growth is 6 years, and their annual growth for the last increase is around 11.11. And you can see prior to that it was probably half of that. So you take 11.11 divided by 2, and that would be right around like 5.5. So pretty decent stock overall. This one has trended quite a bit sideways for the last year. So you can see here, January 2017, it had a high peak in January before falling back down into the $17 mark, and then has recently picked it back up. Now, number 5, we have Monsanto Company. Now, I'm pretty sure a lot of different viewers and subscribers know this stock because of their agriculture products. If you go and buy some seeds at your Lowe's or Home Depot, they are more than likely going to be Monsanto, and they do agriculture products for farmers principally in the United States. It operates 2 segments, seeds and genomics, and agriculture productivity. The company offers its products under the Roundup Ready, Yield Guard, and much more. So they do have a huge list of stocks, items, not stocks. I have stocks on the mind. They do have a lot of products under their name. If you go to your Lowe's or Home Depot and you're buying some of the agricultural products, if you look on the back, you may see Monsanto as one of the production companies. So their ex-dividend date is on Thursday, which is the 4th of January. Their payout date would be the 26th of January. So again, you do need to buy this stock on Wednesday or prior to be eligible for the ex-dividend date, and then you would get paid out in the same month. They haven't had an increase for the last 3 years nearly. So you can see here that they had an increase back in July of 2015, and that was at this 54 mark. You can see that before they were paying out right around 48 cents, 49 cents, and the last time they had an increase, it was an increase of 10.2%. But then again, it's been over 2 years since they increased it. So this is actually, if we took 10.2 and divided it by 3, you would get a little over 3.45. So very low dividend increases over the last few years, and even this 10.2 increase that they increased it to isn't worth it for the last 2 years that they haven't increased their dividend yield. Now they're currently priced at $116.02. Their PE ratio is 22.79, so they did come down hard from last year's time into January, and then have been continuing to grow their stock price. They've been probably increasing their free cash flow, their net income, and their company here, because their price has been going up, but their PE ratio has been going down, meaning that their price in comparison to their earnings has been their price has been increasing, but their earnings has also been increasing. So that's why there's a steady line going down, because even though the price is on its way up, the earnings have been on its way up, which is balancing itself out. Their yield right now is sitting at a 1.86, which is pretty low in comparison to the it's about average for the year. You can see here for the year mark, January 2017 is right here. We can see that it is probably around the about average or below for the year, and their price to book value is pretty high at 7.94. So Monsanto stock, when charted, it shows that the current stock has a higher price to yield, which would indicate it may be overvalued at this time. The stock is under in the industry price to earnings average, sitting below 60% payout ratio, and has had dividend growth for the last 7 years. Their price to book value is 7.94, which is higher than 3.0, where value investors would consider a value. Their stock is currently at 23 price to earnings, or around 22.79, 23. The industry is 38.3. The dividend yield is 1.86. Their annualized payout is $2.16 per share. Their payout ratio is very low at 37.6. Their dividend growth says 7 years, but again, they haven't increased their dividend in the last 7 years, or in the last 2 years. And their last time that they increased their dividend, it was an increase of 10.2%, but they haven't increased it for the last 2 years, so that averages right around 3.4% per year. And that is it. So I hope you guys did enjoy this article. If you did like the article, go ahead and check it out on my website. Remember to like, comment, and subscribe, and share it with your friends. Now, at the very end of each segment, I always like to give my opinion on if I had to pick one stock to invest in, I would definitely choose Cisco as my stock to invest in for the long term, and that's why it is in my current portfolio. I won't be adding to the position right now. I'm waiting for this stock to pull back because it has shot up very nicely in the last couple months. So I am waiting for a little bit of pullback to kind of invest more into a Cisco. So if I had to choose one, I would probably choose Comcast, because while it may have spiked recently, you know what, I probably wouldn't pick any of these right now to currently invest in. The ones that I would pick, Cisco and Comcast, I wouldn't do so at this time. So Bristol-Myers may be the best bet for the current bet, but I would definitely have to do some more research. And again, their price to book value is pretty high, and their PE is pretty high in comparison to where I like to buy at. So that is it for this video. If you guys had to pick one to kind of, if you guys had to pick one, so such like if I had to pick one, I would probably pick Comcast because I already own Cisco. So if you guys had to pick one, would you choose Comcast, Bristol-Myers Squibb, Cisco Systems, Gentex Corp, or Monsanto? So pick one that you don't already own, and then let me know in the comments which one you would pick. So that is it for this video. Thank you guys for watching. If you have not yet subscribed, go ahead and hit the button on the bottom right hand corner to subscribe to my channel. Like the video if you've liked the video, and that is it for this video. Have a great day, guys, and I will see you guys later. Bye bye.